Hello, and welcome to another video of Eindhoven Financial Independence. Today, I would like to talk about the tax system in the Netherlands. I know, this is not the most exciting topic in the world, but we all need to pay taxes to make our modern societies function. Regardless of whether you are already living in the Netherlands or are considering to immigrate here for work, this video will help you understand how taxation in the Netherlands operates and hopefully allow you to optimize your tax situation. In the Netherlands, residents pay tax on their worldwide income, regardless of their nationality. This sometimes comes as a surprise to people who are new to the Netherlands. It is especially important to be aware of this if you have wealth and income sources abroad. The tax administration breaks down your income into three categories or boxes. Box 1 is tax on income from work and from home ownership. Box 2 is income from a substantial interest in a business. And box 3 is income from wealth. In this video, I will focus on box 1 and box 3, as only a minority of people have box 2 income. Box 1 covers income from your work, pension, and various benefits. Importantly, it includes the deemed income from ownership of the home that you live in. Yes, the tax administration assumes a fictitious income from owning a home. As an owner, you have a benefit compared to someone renting. It can also be understood as a type of real estate tax. It is calculated as part of the assessed home value, the so-called WOZ value, and added to your income. It is possible to deduct the interest paid on a mortgage loan from this amount. What this means is that for most people with a mortgage, the taxable income from the owned home will be negative. In other words, you will get a net deduction. I will give you an example of this in a coming slide. Box 1 tax is progressive and composed of two brackets. The first applies to income below 75,518 euros and applies a tax rate of 36.97%. The second bracket applies to any income above that amount and applies a tax rate of 49.5%. To help lower the tax burden of people with relatively low income, there is the general and labor tax credits. As mentioned in the previous slide, in case you own a home, the tax administration assumes a deemed income of 0.35% times the assessed home value. Finally, homeowners with a mortgage can deduct the interest paid to lower their taxable income. In this slide, I present the rules for the general and labor tax credits. You can use these numbers to determine the tax credits for your personal situation. However, I think it is more interesting to visualize the tax credits as a function of income, as I have done in this slide. As we can see, the general tax credit remains flat until it approaches the minimum wage level, after which it linearly phases out. On the other hand, the labor tax credit grows until close to the median wage level, after which it linearly phases off. If we combine all the taxation rules we've seen so far and plot them as a function of wage income, we can visualize the effective tax rate. The red dot at 42,000 euros represents the average income in 2024. As we can see, this income is taxed at an effective rate of 19%. The 40% mark is reached at roughly 100,000 euros of income. It becomes more interesting if we include an own home in the picture. In this example, the red dot represents the minimum income needed to afford a mortgage on an average home in the Netherlands as of Q1 2024. That is 92,000 euros for a home 432,000 euros in value. Without an own home, a person with this income would be taxed at an effective rate of 37%. However, if they own a home, their effective tax rate would go down to 31%. This is the result of deliberate government policy to stimulate home ownership, but which is unfortunately unfair towards people who rent. Furthermore, this policy inflates home prices by making mortgages more affordable. In this slide, I present a detailed calculation of Box 1 tax for the tax incurred in 2023 and which needs to be filed in 2024. I assume an annual brutto income of 50,000 euros, an owned home with an assessed value of 350,000 euros on January 1st, 2023, and 5,000 euros of interest paid on a mortgage. The fact that this income falls within the first bracket is by intention because it makes the calculation simpler. The first step is to determine the taxable income by subtracting the paid mortgage interest from one's salary and adding the notional rental income from home ownership. The second step is to apply the interest rate from the first tax bracket of 36.97% on the taxable income. At this stage, we are due 17,154 euros. Finally, using the rules from slide 7, we compute the general and labor tax credits and use them as a deduction to derive the final due tax value of 10,330 euros. In this example, the effective tax rate is 21%. By following these steps yourself, you should now be able to calculate the tax due for your personal situation. This concludes our discussion on Box 1 tax. Let's switch our attention now to Box 3 tax. Box 3 tax is tax on income from savings and investments on worldwide assets. It is important to understand that this is not a capital gains tax. Instead, the tax administration assumes that your investments have generated an income at a fixed rate, regardless of whether your assets actually overperformed or underperformed that year. This rate is determined by the administration based on their own models and adjusted every year. Because the tax is detached from the actual capital accrual, it is more accurate to characterize it as a wealth tax. Box 3 comes with several deductions and exemptions. The first 57,000 euros of wealth are exempt from the tax, as are green investments up to a point. Furthermore, art, which is used as a decoration of a home, is exempt of tax regardless of its value. Finally, 30% ruling holders can choose not to be taxed in the Netherlands, which is a major benefit provided by the tax scheme used to attract highly skilled immigrants. For the purposes of the Box 3 tax, 3 categories of assets and liabilities are recognized. The numbers in this slide are applicable for taxes due in 2024. Bank deposits and savings are assumed to have had an imputed gain of 0.92%. Investments such as stocks, bonds, funds, and real estate are assumed to have had an imputed gain of 6.17%. What this means is that if you are renting out an apartment, you are not taxed on the actual rental income, but on the deemed income instead. Furthermore, debt is assumed to have an interest rate of 2.46%. Normally, foreign real estate is not taxed if the Netherlands has a tax treaty with the other country to avoid double taxation. However, there is a small amount of tax leakage nonetheless, due to the intricacies of how Box 3 tax is calculated, as I will show in a future slide. Finally, the tax administration exercises a 32% rate on your deemed income. For large portfolios composed of mainly investments, this implies that the effective tax rate is around 2%. In this slide, I provide a detailed calculation of Box 3 tax. I assume 100,000 euros in savings, 150,000 euros in investments, 50,000 euros of debt, and a foreign property valued at 100,000 euros. The taxes are filed without a fiscal partner. The calculation is rather complicated and involves several steps, but please bear with me. In the first step, we determine the taxable return by implying the imputed gain for each of the 3 categories. In this step, we do not include foreign property. The imputed gain on assets is determined to be 10,175 euros. To determine the deductible debt, we need to subtract the personal debt threshold of 3,400 euros. We calculate the deductible interest on this debt to be 1,146 euros. Finally, we subtract the debt deduction from the imputed returns on assets. At the end of step 1, the taxable return is 9,029 euros. In step 2, we calculate the return basis, which is assets minus deductible debts. It is at this point that we include the foreign property into the calculation. After subtracting our total assets with the deductible debt, we determine the return basis to be 303,400 euros. In step 3, we calculate the base of savings and investing by deducting the tax-free capital per person of 57,000 euros. In this example, the basis is 246,400 euros. In step 4, we calculate the share of the return base by dividing the savings and investing base from step 3 with the return basis from step 2. This represents the percentage of our imputed income that the tax administration considers as taxable. In step 5, we calculate the benefit from saving and investing by multiplying the taxable return from step 1 with the share of the return base from step 4. This represents the gain that the tax administration assumes we have earned from our savings and investment. Finally, in step 6, we calculate the tax that we are due to pay by applying the current tax rate of 32% to the benefit determined in step 5. Therefore, in this example, we are due 2,340 euros in tax. If we divide this with our total assets, we can determine that the effective tax rate is 0.66%. This concludes our discussion of box read tax. I hope I have helped you understand better how taxation works in the Netherlands. If you enjoyed this video, please click like and subscribe to our channel. See you next time.